So in this one, I'm going to talk about what I like to call the anytime balloon payment for seller finance. Now, a lot of investors, when I'm consulting with them about setting up their new seller finance loans, whether it's a straight seller finance deal or a wrap loan they're creating involved with the subject to or whatnot, a lot of investors ask about creating a balloon. And they do this for a few different reasons. I think sometimes it's just that they're accustomed to hard money loans with other investors or commercial loans or that type of thing where balloons are common. But the fact is, if you're doing an owner occupied loan, you really want to stay away from a traditional balloon. And the solution to that is my anytime balloon. So the reason you want to stay away from traditional balloon payments in owner occupied properties, there are a number of reasons. Number one, it sets up the borrower to fail. So if you've got a balloon payment, say 2 years out or whatever, you got to understand, how is the borrower going to make that payment? Do they have other cash available they're going to pay you back? Traditionally, balloon payments are made by refinancing. But if the borrower is doing seller finance, that kind of implies they may not be able to get bank financing. So if they can't get bank financing now, I would want to have a really good story and understanding of why I think they're going to get bank financing to refinance at a later date. So we never want to set up the borrower to fail. And the other factor is regulatory. Balloon payments and consumer loans are considered high risk features. There are cases where they can be legally incorporated in loans, but they're generally very frowned upon by regulators. And if you have a balloon payment that the borrower doesn't make and you take it into foreclosure, that's generally going to be frowned upon by a judge, even if you did set it up in a way that was actually legal. So in general, we always want to stay away from those high risk features. So what's the anytime balloon and how does this work? Basically, all the anytime balloon is, it's not actually a term of the loan, but what I mean by that is creating a very high quality loan that you can sell at any time of your choosing. Because if you think about it, the main reason a lot of lenders want to have a balloon is they want to be able to get liquid in some amount of time and not have to wait 30 years for the amortization schedule to run out. But if you create a high quality loan that you have the ability to sell for a good price, well, then you can choose on your own when to pull the trigger and sell the loan at any time you want. You can do it right after you originate it. You could season it for a year and then sell it. Or you could just hold on to it knowing that you have the option, if you want to move that money at a later date, you can always sell and liquidate. So in a lot of ways, it's better than a conventional balloon that hits at some specific point in time. You've really got the flexibility to either exercise this and sell, get liquid in the near term, or wait until the long term. So to me, it's just a much better option. Not only is it compliant, but I feel like it's in your best interest as the investor as well, and it's better for the borrowers too. Okay, so how do we do this? Like, how do we create a high quality loan that we can sell for a good price whenever we feel like it? Well, number one is having solid loan docs. So have your attorney draft the docs. If you're doing a wrap deal or a subject to, make sure you have all the appropriate disclosures. You always want to disclose, both in writing and in person with all the parties involved. It's not a terrible idea to get those conversations recorded either, so it's really clear that everyone is on the same page with what's going on. And then we want to follow all the consumer compliance rules. So part of that is Dodd-Frank, using an RMLO, validating that the borrower has the ability to pay, validating that they have documented income, they don't have recent bankruptcies and foreclosures, and they've made their housing payments on time for the last 12 months or so. And then we also want to send out the appropriate disclosures required by TRID. So we're going to get the loan estimate out 7 business days before we close, and the closing disclosure 3 business days before they close. So the consumer has all the opportunity to read all the fine print if they should choose to do so. The other factor to consider is the pricing, right? So with seller finance, you can often sell a property for more than a cash sale. But we do just want to make sure that you don't get too crazy with that, so that the price you sold it for versus the actual, like what it would appraise for, is in the ballpark of where it makes sense. Otherwise, it's going to be more risky to your potential loan buyer, and they're not going to want to give you as good a price for it. And then we want to structure our deal terms well to maximize our value. So this means getting a larger down payment, um, generally at least 10%. And if you want to really maximize value, get into that 15 to 20% range. Setting a higher interest rate. The quickest way to nerf the value of one of your loans is to create a loan with too low of an interest rate. Now, granted, based on the state you're in, there can also be restrictions on that as well. Um, and then, so how do we find it? And then also the credit worthiness of the borrower as well. We can't forget that, right? There's a big difference between a borrower with a 700 plus credit score and one with a 550. And so what a lot of this comes down to is, how do we find a borrower that has good credit, cash for down payment, can document their income, has a low debt to income ratio, can afford this loan? And we actually have a little bit more freedom sometimes to engineer that borrower than we might think. So step number one is pre-screening your borrowers, having that conversation with them to understand their income level, their debts, if they have any red flags in their credit history, if they know approximately what their credit score is. If their credit's good, they often at least have a pretty good idea. And we want to be a little bit patient and not necessarily just take the first buyer that comes along, right? Part of this pre-screening process, it's almost like a dating process. We want to find the right person that's going to maximize the value of our loan, not necessarily the first person who comes along. So we want to be super patient with the process. And then, the other thing we can do is we can offer different terms for better borrowers, right? So, what you can do is, it's fair game to advertise that, hey, if you've got a meet a certain, like, here are the terms of my deal, but if you can put down this higher down payment and you have a credit score of X, I'll either give you a better interest rate or a better price on the loan. And I've done a lot of playing around with spreadsheets at these various loan terms and compare them to what buyers are willing to pay for them. And you've really got a lot of flexibility to set terms if you've got a borrower with good credit, good down payment, and well documented income. So to kind of wrap this one up, if you're thinking you want a balloon payment because you want to get liquid, the easier way to do it is to create your high quality note to where you'll essentially have built yourself an anytime balloon payment that you can exercise whenever you feel like. All right. Thanks for watching. I'll see you next time.